This is level 1 of the CFA program, the topic on financial statement analysis and the reading on understanding cash flow statements. That last LOS is important for this reading, but it's going to be super important for us when we get to, what did I say, capital budgeting, but also equity analysis. We're going to look at free cash flows. And then, of course, just like we did in the balance sheet and just like we did in the income statement, we'll go ahead and calculate and interpret some ratios. Remember, in both balance sheet and income statement readings, we did these common-sized financial statements. Well, we can do the same thing here inside of the statement of cash flows. And so what this is going to do is this is going to give us a sense of the percentages and how those percentages have changed over time. And this is what I tell students all the time. And I hope I said this back in the balance sheet and the income statement readings, but I might not have. So I'm gonna say something really important here that can be applied back there. That the main reason that we use these common size cash flow, balance sheet, and income statement is to see the proportions, but also to see the pattern of proportions over time, so that we can see whether we are increasing our ability to generate cash, and we can see where we are using that cash over time. So think about the patterns. That's extremely important for the internal evaluation of this company. But then, comma, there's a comma there, then we want to use those patterns and those proportions to compare it to other firms. Remember, as good financial analysts, we're trying to find companies that are undervalued or overvalued. Well, this is one way to do it. Look at the common size balance sheets, look at the patterns, and then compare them to all of the similar firms. And this kind of tells you something about, okay, if all these firms were the same size, what would those proportions be? And that's what this really means, that first bullet point. Yeah, vary depending on its growth stage, both the sources and the uses of cash. Now look at that second one there. This is almost silly for me to say. A company must generate cash flow from operations, right? What's the goal of the business? The goal of the business is to maximize shareholder wealth. Well, how do firms do it? Well, they find product lines, they find long-term assets that are going to generate cash, not just today, but next week and next month and 10 years from now. You know, I worked in this donut factory. It's a locally owned factory. I went to school with the children of the owner. That's, of course, how I got the job. But you know, they've been in business since 1942. So they're selling donuts all the way back, you know, a long, long time ago, almost 100 years, right? They did it through the 60s and the 80s and the 90s. And they managed to generate cash flow, even though I was probably a terrible donut maker during my summer employment. How about operating cash flow? So we've talked about this, right? Changes in working capital. Think about that as investments in the short term. Remember, working capital is current assets minus current liabilities. And what do we know? We know that whatever extra cash we have, we don't want it just sitting in a pile in the corner. We want that extra cash to be used efficiently. Whether or not it's something like, hey, let's use that cash and let's invest it in a treasury security over 1 week or 1 month so we get a return on our investment, or does it mean taking that cash and paying for our accounts payable sooner rather than later, or something else? Does it mean paying later rather than sooner? And so think of that changes in working capital as a source of cash or a use of cash, depending on operations. I'm going to give you a great example. Take a company like Procter & Gamble. You know, Procter & Gamble makes stuff that hopefully we use every day, right? Like toothpaste and shampoo and soap. And you know, what is the cash flow for Procter & Gamble look like? You know, it goes up and down and up and down and up and down. And if you compute the current ratio for Procter & Gamble over the years, you know, it's like 0.7 or 0.8, but it's almost always less than 1. And so you think, oh my gosh, oh my gosh, Procter & Gamble, they can't pay their bills. Well, this company's been around for thousands of years, so you got to think they probably have some kind of a strategy to make sure that it pays its bills. And so what Procter & Gamble and a lot of these big companies do is they use commercial paper, the issuance of short-term security, to plug in any cash gaps. And so the changes in working capital can be a really fascinating study of just managing cash inflow and cash outflow during the short term. But then I want to say something here in this second bullet point. Notice that the reading talks about earnings quality. So what does this mean? The quality of the earnings. When we're looking at firms that are undervalued, we want to look at firms that have sustainable earnings and they have a moderate growth rate in earnings. That must mean that the company's generating lots of cash flows to support that earnings quality. And then maybe something's happening in the marketplace in which the price is a little bit lower than what it ought to be. So we look at earnings quality, and that's going to depend on not just net income every year, but the operating cash flows. So we look for increases in net income and we look for increases in operating cash flow. And how do firms do that? They turn their product lines into brand names so that when Milton Hershey wakes up today and he makes 100,000 Hershey Kisses, well, what does he know? He knows that he's going to be able to sell those and generate cash. And if those cash flows are increasing in a sustainable and steady manner, then we can reasonably conclude that Milton Hershey common stock has its price is based on high quality of earnings. And then look at the bottom there, ability to forecast future cash flows. I've mentioned this multiple times, and I'll just keep talking about forecasting cash flows again and again. All right, so what are we doing looking on the bottom left of the balance sheet, property, plant, and equipment? What do we want? We want our company, as good financial analysts, we want to find a company in which that long-term asset section of the left-hand side of the balance sheet is growing. And we have a couple of problems with that because over time, we're depreciating those physical assets, right? And we're amortizing the other assets. And so that accumulated depreciation, it eats in to the book value of those assets. So as good financial analysts, we want to not only know what the book value of that is, which is determined by these investing cash flows, among other things, the method of depreciation, but we also want to see that we are reinvesting back into the equipment, right? If our machine breaks down, we want to fix it. And so when we fix it, if we fix it enough, we can capitalize that expense and we can spread that out over time. And so what do we want? We want machines that last for a long time. Now, we don't want machines that last for 80 years, but we want to make sure that that machine is in perfect working condition so that it can produce all of these product lines that we've promised our customers. So make sure that you're aware of a question stem that says something like, hey, here's an asset for a company and they sold it. Is this good or bad? Well, of course, when we sell an asset, we're probably going to get cash. So that's a cash inflow, but that's probably a one-time cash inflow, right, for that asset. So then we have to ask ourselves the question, was that a strategic mistake or is it in our best strategy to sell that asset? And I'm linking, you see how I'm linking these investing cash flows with our ability as good financial analysts to find under or overvalued firms. And then, of course, cash flows. How have I defined cash flows? I haven't done it yet today. I'm going to do it right now. But how have I defined cash flows in lots of these readings at level 1? Cash flows are the amount of cash remaining after all expenses have been paid. That should make perfect sense. But it can also be considered as the cash remaining that is available for reinvestment. Oh man, what do we want to do? We want to generate enough cash flow that we can find wealth increasing projects without having to go to the external markets. So that's what that last bullet point is telling us. Useful to consider the sources of cash for major capital investments. Now, this leads right into raising capital or repaying capital. Suppose we don't have enough internally generated cash flow and we have to go to the bond market or to the stock market to raise capital. This is called the capital structure of a firm. And boy, we're going to have some super fun and exciting conversations about capital structure. And I mentioned these two gentlemen earlier in this lecture. I'll mention Franco Modigliani and Merton Miller when we talk about capital structure. Now, here's this slide on the common size cash flow statement: percentage of flows, percentage of inflows, percentage of outflows as a percentage of net revenue. And so all the stuff that I mentioned a few moments ago is summarized here on this slide deck. All right, now we're getting to something that is right up our alley as good financial analysts. What did I just say operating cash flow was? The amount of cash remaining and available for reinvestment. Well, free cash flow is the amount of cash remaining after all expenses have been paid and all investments have been made. Now, we need to distinguish between free cash flow to the firm, that's this one here, and free cash flow to equity. That'll be our next slide. But what I want you to do is I want you to look at that middle equation there. So free cash flow to the firm, right? Forget about the top stuff. What we're doing is we're going to take out capital expenditures and we're going to take out working capital expenditures. So you ready for this? What we're going to do, what did I say earlier? Free cash flow, the amount of cash remaining after all investments have been made. Well, we can make long-term investments. The reading calls those capital and expenditures. Those are investments in property, plant, and equipment. And we can invest short-term investments. Those are working capital expenditures. Things like, what did I say about my donut experience? We're investing 10 more pounds of sugar. That's an investment in sugar as part of our, boy, I don't even know, I'm not a good accountant here. What would that be? That would be a raw material, right? The sugar there. And then when I would pick that big bag up and I would go and I would dump it in the vat. I guess when I dumped it in the vat, it became part of the materials in process or work in progress, whatever the accountants call that thing. And then at the end, when the donuts would come off, and I tell you what, this is why I was a bad donut maker. I bet I ate 20 donuts a day while I was working. Oh, there was nothing better than a chocolate-filled donut right when it comes off the conveyor belt. All right, so let's think about this. Free cash flow to the firm. So let's look up at the top in bold. What's the definition? It's the cash flow available to a company's suppliers of debt and equity. So that's the right-hand side of the balance sheet. So what do we need to do? This is free cash flow to the firm that we can use to do things like pay interest expense to the bondholders and pay dividends to the shareholders or repurchase their shares. All right, so let's look at the equation because look up at the LOS. So this is great news. Those of you who love calculations, there's a calculate free cash flow to the firm. And so what we're going to do is we're going to start with net income. We're going to add those non-cash charges like depreciation and depletion. And then we're going to add the 1 minus the tax rate times the interest expense because we get a tax subsidy from the federal government because the interest expense does in fact show up on the income statement. And then we're going to take out long-term investments. The reading refers to that as capital expenditures, and take out short-term investments. The reading refers to that as working capital expenditures. Or you can just start with cash flow from operations, and you can subtract out the long-term investments, and then add back the tax subsidy. So either one of those. So here's my advice when you get to this calculate question on the exam. I'm guessing, remember now, we don't know what the CFA Institute is thinking, but I'm guessing, and if I were creating an exam, I would either give you net income in the problem, in which case you'd have to use that first formula, or I'd give you cash flow from operations, in which case you would use the second equation. So remember, here's my second part of this advice. In order to be able to prepare and manage these types of calculate questions, it is super important that you know what the Institute has to give you. So when you read the question that says, compute free cash flow to the firm, you should automatically be thinking, okay, I'm going to look for net income or I'm going to look for cash flow from operations. And I'm guessing the Institute would only give you one of those two. If they give you both of those, then they have to give you a bunch of the other information as well. Now, free cash flow to equity is, wait a minute, what did we say back here? Free cash flow to the firm is the cash available to all the stuff, all the people, all the investors on the right-hand side of the balance sheet. Here, free cash flow to equity, you would suspect available to common shareholders. So we're going to start with cash flow from operating activities. We're going to subtract out those long-term investments, and then we're going to add or subtract the borrowings that go in there. Did we issue some bonds? Did we call some bonds, et cetera, et cetera? And so notice the bottom arrow point down there. Positive free cash flow to equity implies the company has more operating cash flow that it needs to cover capital expenditures and the repayment of debt. So what's the goal of the business? The goal of the business is to generate lots and lots of operating cash flow, right? And if the firm generates lots and lots of operating cash flow, over time, free cash flow is going to expand. So the question then becomes, what do we do with all of that free cash flow? If there's a huge amount of cash, and are you ready for this? We don't have anything to do with it, right? To cover capital expenditures and the repayment of debt. Now, this has nothing to do with this particular LOS, but in level 2, we're going to answer that question. And one of the answers to the question is, we're going to start looking for other firms to take over. If we have tons of cash flow, why don't we take over that firm over there? And you know what? We're smarter than those executives over there, so we can turn that into a wealth increasing project. But that's a conversation for another day, and it's a super exciting conversation. All right, let's do a quick example here. So let's do free cash flow to equity, given a bunch of stuff there. So what are we going to do? We're going to start with the cash from operations, 500. We're going to subtract out our fixed capital of investment, right? That's an investment in a wealth increasing long-term asset. And then what did we do? We started out with 200 and we ended with 250. So that must means we borrowed 50, right? So how much is available? So we got the 50 minus the 100, that's 400. And then we add the 50 of that kind of extra borrowing or borrowing that occurred during the year. So we get to 450. So that's a super easy example. Now, what do we do in balance sheet? What do we do in the income statement? We ended our slide deck with a conversation about ratios. And if my memory serves me correctly, we just did 2 or 3 ratios for each one of these, but we're not doing just 2 or 3 here. Let me show you all those. All right. So I'm warning you that there are more than just 2 or 3, but these are going to be just as easy as they were earlier because, look, I want you to see the numerator. Here, let me go back real quickly. Let me go down, let me go down, let me go back, let me go back. There's a little game. I hope I didn't give you vertigo there. What's in the numerator? The numerator is cash flow from operations. All right. So we just spent lots of time computing that cash flow, and now we're going to put this in the numerator and we're going to divide it by something that's really important or relevant to our particular analysis, right? So if we want to know what is cash flow to revenue, what is cash flow to assets, what is cash flow to equity, what is cash flow to net income or operating income, and so what do we want? I mean, what do we want in terms of these ratios? Do we want them to be low? Do we want them to be 0? Do we want them to be 1? No, of course not. I mean, we want to generate lots and lots of cash flows. We want to have, let's just look at that first one. We want to have $10 in sales, and we want to have $10 in cash flow, right? Oh my gosh. So 10 over 10, that would be super. So there's an example where we would want that to be closer to 1, but of course we're never gonna have that. So cash flow to revenue, that's almost like a return on operations, right? It's almost like net income over revenue. But now we want that to be cash flow, which represents the true quality of the asset. So return on assets, or return on equity. So what do we want these numbers to be? We want these numbers to be 10%, 20%, 30%. And then depending on the denominator, like look over here, cash flow per share, debt payments, dividend payments, we might want these to be high. So it's relatively straightforward to to interpret these ratios based on whatever is in the denominator. And here's a couple other ones here, right? So I'm going to throw a little wrench into our discussion. What do we want for a debt coverage ratio? Do we want cash flow to be 10? Do we want total debt to be, do we want that to be 10? Do we want it to be 100? Do we want it to be 1,000? Well, here's where we get into the interesting conversation about capital structure. We like debt because it gives us an interest subsidy. So we're going to be encouraged to issue debt, but we want to make sure that we have enough cash flow from operations to cover that debt. So let's do a quick example for one of these ratios. Look at the bottom right. Debt payment ratio is closest to. So notice I give you net income and we give you some balance sheet stuff. We also give you some income statement stuff. There's an interest expense. We also give you some stuff from another part of the cash flow, increase in capital expenditure. Now, maybe we got that from changes in long-term assets on the balance sheet, debt issued and debt repaid. We probably get that from maybe a note somewhere. So let's go ahead and compute the cash flow and from operations. So that's our numerator, right? So let's just do the same thing that we did earlier, 700 plus depreciation, plus we decrease the accounts receivable, right? And then we subtract out the 36 of an increase in inventory. And there's 770 over the debt repaid. So where did we get that? Oh, there, that's at the bottom, debt repaid. So that's 2.33. So what does that mean? That means that for every dollar in debt that we repaid, we're generating $2.33 worth of operating cash flow or cash flow from operations. So let's be careful. What happens if this number is less than 1? Well, then we're not generating enough cash flow from operations to repay our debt. Boy, this brings in the specter of financial distress cost or maybe even the specter of bankruptcy. So what do we want this number to be? Well, we probably want this number to be higher rather than lower, right? We want to get it away from 1, but we don't want it to get to be too high because then maybe we're not using enough debt financing in our capital structure. So notice our exclamation point there. Challenge is clearly calculating cash flow from operations first. Now, what I want you guys to do, and we didn't do this because it would take too long in a slide deck, but I want you to go back and I want you to look at these and I want you to go back and compute all of these performance ratios and then make some kind of a conclusion, which is what I did. Now, you're not going to be able to do them all because you don't know, for example, you don't know what total assets are, but just make up a number. Say total assets is, 2,000 in this example, and go ahead and do which I went the wrong way. Go here and do the cash return on assets, compute that ratio, and then interpret it. That's your homework assignment. And that takes us through the LOSs. So thank you for watching and good luck studying.